Hi everyone, welcome to our discussion on this topic which is financial instruments. Friends, this particular section is I think I would say one of the most sensitive yet an important section within the financial instruments, where we try to understand the derecognition principles. Okay. In a very simpler language, if I say I'm owning, let's say for the sake of convenience, we are using the section discussion for financial assets. So if I say that I have a receivable in my books worth 1,000, okay, and I do a non-recourse factoring thereof. As in, when I say I'm looking at non-recourse factoring, I have actually speaking sold off my receivables to some factor, right? Or maybe to make it more elaborative, we are saying that from my receivables I do not have any rights to collect money, from there, right? That is something which is a very basic attribute of a non-recourse factoring, right? So when we say that this non-recourse factoring has taken place, let us say I received 980 for this, all right? So effectively what I'm saying is that I need to remove the receivable from my books, right? Or I would safely say I have received this 980, and of course I am showing that this receivable of 1,000 is now derecognized. Naturally, here we are saying that it's an expense of 20 arising in here, right? I'm not bothered about whether this goes to P&L or does it go somewhere else. What we are rather saying is that this receivable is taken away, or eliminated or removed from my balance sheet here. Okay, so that is something which is broadly the idea of derecognition. I stop recognizing the asset in my books now and onward. All right. What we are not here talking about again the meaning of derecognition, or what all needs to be done, what all conditions must be met for a financial asset. For example, to begin with, we are not looking at financial liabilities at this point in time. So we are saying that if I need to derecognize a financial asset, then there is an entire set of conditions that must be met, and a very, very, very comprehensive, set of conditions need to be met, and then only we can identify, whether we have, whether we can derecognize, let's say, a financial asset or not, right? What we are rather, willing to discuss here is that should the derecognition principle the derecognition principle be applicable for the entire value of the financial asset, or a part thereof, right? This is something that we want to discuss specifically in this particular lecture, right? So what we are saying is, whatever those conditions are in terms of whether I have a right to recover my money from the receivable or not. There could be different parameters like risks have been transferred, rewards have been transferred, control has gone. We are not even talking about that. We are rather saying whether those conditions would be applicable to the entire amount of the financial asset or only a part thereof. Okay, let's try to understand it with the help of a small example again. Let us say that I give a loan to company Y amounting 1,000 at the rate of 6% per annum. Okay, right? The tenure is 4 years, after which the loan is recovered at its par value. Okay, right? Basic example. So when I look into this scenario, here I'm trying to say that ideally speaking, this 1,000 is a representation of what? Right? What does this 1,000 reflect? We are saying safely that I'm in receipt of 60 at the end of year 1, minded that I'm receiving an interest of 6% per annum. Okay, so 60 is received at the end of year 1, 60 is received at the end of year 2, 60 received at the end of year 3, and 60 plus 1,000 received at the end of year 4. Okay, right? Now effectively what we are saying is we have an interest portion recoverable, okay, and we also have, of course, principal portion recoverable. Of course, the money does not come today. The money comes over a period of time. All right. So I can safely say this 1,000 today is nothing else but present value of interest receivable, right, plus the present value of principal at maturity. Okay, right? Now what we are saying is essentially my financial asset, which is loan, may rather be divided into two components. Okay, one is the interest portion and second is the principal portion. Okay, so if I say that let's say theoretically, I'm not saying that we have done the calculations, we do not want to do that. Okay, so let us say the present value of interest receivable comes to, of course my interest rate is given as 6% and I'm looking at 4 different amount of 60 each over the next 4 years. So there is an interest component. Let's say for the sake of argument this comes to 150. Okay, of course the principal amount will be 850 here. That is where the total would become 1000. Right? Precise calculations can be done. All you need to do is the present value need to be calculated as 1.06 to the power 1, 1.06 to the power 3, 1.06 to the power 2 and 3, and then whatever you receive at the end of year 4, it would be 1.06 to the power 4 here. Okay. So all what I'm trying to say is, if I purely look at the interest component, whatever is the present value, assuming this is 150, we are saying that the present value of the principal comes at 850. All right. So what we want to say now, that if I were to forego my rights to recover interest portion. Okay, if I were to forego my interest portion, effectively what I'm trying to say is that I need some money urgently, but I do not want to sell my entire loan asset. Okay, so let's say I only need, maybe I just need 140, something like that. Right. So what I do is I approach another person, a counterparty, wherein I tell him that I would like to sell my rights to receive interest. Okay. I'm willing to sell my rights to receive interest over the next 4 years. All right. Which means what? Here I'm saying, so we don't need this calculation, so we can avoid it. Here I'm saying that I sell the interest portion for 140 here. Okay. Now what does it imply? It implies that out of my loan of 1000, I'm selling something worth 150 for 140. Okay, which means that now there is a portion of my loan asset that will be de-recognized. Okay, right? So I don't have to really say that I'm selling my loan at 1000, which is okay. So we're just standing at 1000 for 150, and I'm taking, some cash back, and then I'm reinvesting that amount, and now I'm, let's say, required to only have a right to receive the balance amount of 850. No, we're not saying that. We're safely saying we have divided this loan into two categories. One is the interest portion, second is the, of course, loan portion, right? The principal portion precisely. So of this 150, if I'm only realizing 140, effectively the way I'm doing the accounting, okay, the way I'm gonna do the accounting is the day when I made this investment, I said debit asset 1000, credit, of course, you paid 1000 to somebody, okay, and then we are saying that when you sold off this 150, of course, to that extent your loan asset is de-recognized. Credit asset 150, you are receiving back how much? 140, which means that there is a loss on de-recognition of 10. Your other 850 stays in your book. It doesn't go anywhere. All right. How do we look at those measurement principles, the de-recognition principles? What we were trying to talk about a while ago is risk and rewards, control, all those stuff, we are still not talking about that, but we are rather saying in this scenario we are able to identify a portion of my financial asset which needs to be derecognized. Sounds okay? Yep. So what we are now saying is, it is absolutely important for us to identify. It is absolutely important for us to identify whether we should derecognize the entire financial asset or a part thereof. Okay, and when we say looking at a financial asset, it could also be with respect to a group of similar assets. Okay, so if I say that I'm a banking company which holds a financial asset of home loans, there could be thousands or millions of customers from whom I'm supposed to recover my money back, let's say against those home loans. So there would be an entire portfolio of such financial assets. So again, what we need to understand is, we need to identify first of all whether we should derecognize the entire financial asset or should we derecognize a portion thereof. Okay, so what the standard has done for us, very importantly, it has suggested that we may derecognize, or we should only be able to derecognize a part thereof, provided any of the conditions are met. So they have specified 3 conditions precisely, right? They say that if any of these conditions are met, then we should be able to say that we need to derecognize, or we can derecognize a part or a portion of the financial asset. Which also means if none of these conditions are met, the entire financial asset has to be derecognized for that. Okay, right? Which also means, of course, a group of financial assets there, right? So what are these conditions? Let's talk about those one by one. It says that when I'm saying the derecognition, right, I'm able to say, or I'm able to, let's say, have specifically identified cash flows. Okay, we are saying I may be able to say that I'm derecognizing a part of my financial asset when I do not have a right to recover specifically identifiable cash flows. Okay, so if I say, for example, I had a loan of 1,000, the same example that we used a minute ago. Okay, the interest portion comes at 150 and the principal portion, both of course considering the present value thereof, right? So if I say that I'm only selling off my interest, okay, this is also referred to as interest strip. You are stripping off the right to receive the interest now. Okay, right? Now imagine why would probably want to do that. One way is that you let's say, we talked about this, that the tenure is 4 years Okay, and then you know also that the interest rate is 6%. Okay, now imagine it like this. There is a counterparty which believes that the interest rates may decline. Okay, but then this particular interest strip is allowing you, or of course permits you, to still receive interest at 6%, right? So the other party might be interested in offering you, let's say, a cash immediately in return of fixed interest payments, right? You, on the other hand, may have a different attribute altogether. You might rather be thinking, well, I have provided the loan at 6%, but now I believe that the interest rates may increase. Okay, so what you may want to do is, you may want to, let's say, let go the interest portion, take some money and then reinvest, let's say, possibly at a higher interest rate. Okay, so in this situation, when I say I'm looking at an interest strip, we are saying that there are specifically identified cash flows out of the entire financial asset, which, for example, relate to my interest portion here. Is it okay? Right? Comfortable with that? Great. Let us say, if I talk about yet another scenario with it, I'm saying that you have investment in a share, okay, that normally pays dividend at the rate of 10% per annum. Okay, you have invested in a share which normally pays a dividend of 10% per annum. Okay, now what you do is, you keep the share with yourself, right? But since this company in which you have made this investment, you are saying that you sell the right to receive dividends for next 5 years. Okay, you're saying that you sell the right to receive dividends for next 5 years. What does it imply? Of course, if I say I'm using, something like a dividend model theory, right? Or maybe a dividend growth model to value my shares there, right? Effectively, what I'm trying to say, it is measurable, it is identifiable that this investment in a share is going to give some returns in form of a dividend, right? So if I say that some portion of that cash flow, if I'm able to sell it to somebody else in return of a consideration, can't that be also considered as specifically identified cash flow, right? I'm not selling the share, but I'm selling a portion of that particular share which is very much specifically identified. In this case, for example, whatever is the dividend that I'm going to receive for the next 5 years, that is specifically identifiable. Okay, which means that instead of de-recognize the entire share, I only de-recognize this much component. Okay, that is something which is the contention of this particular requirement of the standard. It says that you need to, or if you're able to prove that there are specifically identifiable cash flows or specifically identified cash flows, you can very well use the de-recognition principle for that portion. Okay, yeah, Now this is one part here. The second part is more complicated, I would say, as against the first part, but at the same time it's an important consideration that we need to make here. We are saying now that the part comprises of a fully proportionate or a pro rata share of cash flow. So this is my other condition. If the first one is not met, but the second one is met, then I'm also happy. Okay, so we are saying that if my sale arrangement, I'm owning a financial asset, but I'm saying that my sale arrangement suggests that I can rather sell a proportion of my cash flow, right, on a pro rata basis or a pro rata share, of course. Even then I can de-recognize that pro rata share out of my entire financial asset. Okay, so if I say, for example, let's say that there are I'm owning 5 loan assets, right? So in easier language, I'm saying that I've made an investment of 5 similar, assets. I've given loan to several people, and I wish to sell a portion of, this portfolio, right? So of course, if I have more than one asset, I'm saying that I'm carrying a small portfolio here. This reference, of course, comes to the group of similar assets. That's the reason I'm using this particular terminology. So I'm saying that there's a 5 loan assets that I'm carrying in my books, and for example, let us say the value of this is 100 million in my books. That's the carrying value here. All right. Of course, we are saying that there could be different people with whom I'm getting into an arrangement, and I'm, let's say, having this total value of 100 million as my financial assets. Okay. Now what we are saying is, for example, I'm selling off 80% of cash flows associated with these financial assets, right? So whatever money I'm supposed to receive against this particular financial asset portfolio, we are saying that 80% I'm selling off for some consideration. Whatever the consideration is, we are not worried about that at this point in time. Of course, the accounting shall follow later, but precisely I'm saying that this is the pro rata of my cash flows, right? That means that now my de-recognition, 80% of the financial assets will now be de-recognized from my books here. Okay, so the 80% of the cash flows will now be de-recognized from my books here. Okay, right? Now this is something which is, of course, let's say quite straightforward again to assume. But then if I say just try to kind of bring some modification to the to the scenario here. We are, let us say, saying here we are saying that I've sold off or I've agreed to sell 80% of the cash flows associated with the financial assets, but would like to compensate to the extent of let's say 8% of loss. In a way, I'm offering a guarantee back to my counterparty, right? Wherein I tell that party that just in case the financial assets do not result into a realization, I will be able to, let's say, compensate to the extent of, let's say, 8% in this case, right? But just to make it easier for ourselves, we are saying that I have my receivables, okay, to the extent of 100 million. I do a non-recourse to the extent of 80 million, right? Which means that this entire 80 million should ideally become the responsibility of the factor now. I don't care whether they pay the money or not. If I do not care, we are saying 80% pro rata derecognition must take place. But then if I'm offering them a guarantee, okay, let's say in this case we said it is 8%. Right? So here we are saying that if there is a guarantee involved, effectively I'm not really transferring my risk and rewards to the other party per se. Okay? So effectively what I'm trying to say here is that if I look into this scenario, that where I'm offering a guarantee, then I'm not really letting that receivable go effectively, because I'm still carrying something on my shoulders back. But then what we are saying is now from this perspective of a guarantee, we are saying that the fully proportionate or a pro rata share is this condition is not set to have been met here. Okay, what we need to say here is, what we need to understand here is that I'm not able to really have that 80% derecognition happening at all in my books. It would be either 80% or it would be full. It cannot be 80% subject to a condition like this recoverable, right? So effectively what we are saying is, when this kind of a scenario takes place, we would say that it was not specifically identified and it's not even fully proportionate. So that condition is not said to have been met here. Okay, so that is something which is again a consideration that we need to make when we look at this kind of a scenario here. Okay, right? So when I say that I'm looking at this kind of a consideration, we look at the two conditions already, specifically identified cash flows or fully proportionate or pro rata share of cash flows. The third condition that comes here is, it says that fully proportionate or pro rata share of identified cash flows, fully proportionate or pro rata share of identified cash flows. Easier example, yet again, if I say I have a loan asset of 1000, the interest portion present value comes at 150, the principal portion present value comes at 850. If I say that I am selling off, I want to derecognize 60% of interest only. Okay, that means I have identified cash flows, which is interest. Okay, and within that I'm taking a fully proportionate or a pro rata share, that is 60% here. Okay, so what it means that out of 1000, my financial asset at 1000 will now be derecognized to the extent of, let's say, 90. So whatever I recover against this, interest portion, that would become my recovery, and whatever the difference comes is, of course, would be the differential amount. So this 90 will go away from my balance sheet, and I would have balance value standing at 910. Sounds okay? Sounds comfortable? Right? Now specifically, what is important to understand here is, so that we are able to kind of appreciate the standards requirement here is, if I say again that I have 5 loan assets worth 100 million. Okay, and I'm saying that I would like to derecognize 90% of first cash flows. Right? So we are not talking about a single asset here or single receivable. We are saying that if it's a portfolio or a group of financial assets, and I'm saying that I would like to sell off my right to recover, let's say, first 90% of cash flows, or let's say last 90% of cash flows. Okay, now the challenge that is there is essentially in a very open statement like this, is that of these 5 loan assets, which ones represent first or last 90% of cash flows, right? So we don't know that, right? Think about it like this: you have 5 customers, different amounts due from them each, the total comes to 100 million. You say that you approach a factor, you want to do a non-recourse factoring, and you tell him that I'll be selling off 90% of my total receivables, the first 90% of my total receivables. Okay, now it is not specified from which customer how much becomes first, or let's say the last one. So in this case, again, it is not possible to measure what are those specifically identifiable cash flows and the pro rata thereof. Okay, that means if this scenario comes, we are saying entire portfolio will be derecognized in this case. The pro rata or a part thereof scenario is not assumed to have been met here at all. Right? That is something which is another important consideration of this standard here. Right? On the other hand, if I just were to kind of put it like this, that there is For example, a loan asset, let's say worth 1,000. So you're given some investment, you made some investment of 1,000, and the term comes to year 1, year 2, year 3, year 4, year 5 and year 6, right? So each year you are entitled to receive 6%, and of course at the end of year 6 you receive the principal amount as well, right? So this is my timeline. Okay, so what you're saying now is you wish to sell. So this is of course a negative amount, my investment is going away. You wish to sell the right to cash flows for first 3 years. Okay, for some consideration, does not matter how much, right? Which means that now this 60 and this 60 is very much identified. Okay, or even better, if I say that you sell the right to the cash flow for first 3 years, 40% thereof, right? That means that 40% of 60 for year 1, year 2 and year 3. This much amount will be calculated at its present value, and to the extent of that amount, it will be de-recognized from the balance sheet, and the remaining amount of 1,000 will continue to be shown in the balance sheet. Okay, right? That is something which is one area, the beginning of my de-recognition principle specific to the financial assets. That is something which is of course applicable here straight away, right? So what we need to understand here is precisely we are actually talking about the de-recognition principles to begin with for financial assets. That's one part. The second important part is that should I de-recognize the entire asset, or can I de-recognize a part thereof? And when I say I'm talking about an asset, I also intend to say group of similar assets, receivables, loan portfolio, investment in bonds and stuff like that. Okay, so when we say that you're looking at de-recognition of a part of financial assets, there are 3 conditions attached. Any of these being met, to that extent the portion can be identified, right? What are those 3 conditions? We have talked about that as well. We are saying that there are specifically identified cash flows. An example would be of course an interest strip or a dividend strip. We talked about that dividend model case where you are letting go the right to receive dividend for the first 3 years, 4 years, 5 years, 10 years, whatever, right? Second is fully proportionate or pro rata share of cash flows. We talked about that example of 80% of cash flows. Okay, and then we are saying that just combine these. You want to let go 60% of the first 2 years interest. You may want to let go 80% of the principal only at the end of the term. Anything then, anything may come as a part of this discussion. So when these are identified, to that extent of the portion of the financial asset will be de-recognized from the financial statements, right? That's one important thing that we have started talking about now on de-recognition principles. There's a lot of content on this area, and certainly a very interesting yet of course complicated one. So do keep watching these lectures and subscribe to our channel, that is ABC Learning. All the best and take care. Have a good day. Bye.